Section 10.3, banking. What is money supply? Money supply is all the money available in the United States economy. It includes currency, travelers, checks, checking account deposits, and other stuff. Dividing the money. In order to track the different kinds of money, it's divided into several categories. The ones discussed in this section are M1 and M2. M1 represents money that people can gain access to easily and immediately to pay for goods and services. Components of M1, checking accounts. About 55% of M1 is made up of currency held by the public. Another large component is deposits in checking accounts. Funds in checking accounts are also called demand deposits because checks can be paid on demand. Checkable deposits. Until the 1980s, checking accounts did not pay interest. When they began paying interest, a new component of M1 called other checkable deposits was introduced. However, this category is not as meaningful as it once was. Traveler's checks. Traveler's checks make up a very small part of M1. Unlike personal checks, traveler's checks can be easily turned into cash. M2 savings accounts. M2 consists of all the assets in M1 plus several additional assets. These additional M2 funds cannot be used as cash directly, but can be converted to cash fairly easily, also called near money. For example, deposits and saving accounts are included in M2. They are not included in M1 because they cannot be used in direct financial exchanges. You cannot use your savings account passbook to buy a backpack, but you can withdraw money in order to do so. Money market mutual funds. Deposits in money market mutual funds are also included in M2. It's a fund that pools money from small savers to purchase short-term government and corporate securities. They earn interest and can be used to cover checks written over a certain minimum amount, such as $250. Functions of financial institutions. Banks and other financial institutions are essential to managing money supply. Storing money. Banks provide a safe, convenient place for people to store money. They keep cash in frequent, fireproof vaults and are insured against the loss of money in the event of robbery. Saving money. Variety of ways for people to save money. Savings accounts, checking accounts, money market accounts, and certificates of deposit. Saving accounts and checking accounts are most common and are especially useful for people that make frequent withdrawals. They also pay interest at an annual rate.
Yeah. Oh yeah, sorry.
Loans. Banks also provide loans, which is a very important service. The first banks started doing business when goldsmiths issued paper receipts. These represented gold coins that were held in safe storage. They were fully backed by gold. Eventually, the goldsmiths realized that customers seldom asked for all their gold at once, so they loaned out some of the gold. That way they could make interest. Fractional reserve banking is a banking system that only keeps a fraction of its funds on hand and lends out the remainder. Banks lend money to homeowners for home improvements, to families to pay for college tuition, and to businesses. This can help new businesses get started and help established businesses grow. When a business gets a loan, that business can create new jobs and help other businesses grow. So for example, if you and a friend started up a window washing business, you could get a loan from the bank to buy the supplies you need, and the bank would pay for the supplies, so that company that makes the supplies would get your money. Security of a business must be taken into account, or borrowers might default. Default is failing to pay back a loan. A mortgage is a specific type of loan that's used to buy real estate. Suppose you want to buy a house that costs $250,000. There's very little chance that you have that much money on hand. You need to take out a mortgage. Usually a down payment is put down on the house. 20% of this loan would be $50,000. A mortgage lasts usually 15, 25, or 30 years, and the homeowner pays back the loan plus interest and regular payments over that period of time. Credit cards. A credit card entitles its owner to buy goods and services. How does a credit card work? So suppose you spent $250 on new clothes. Your credit card bill won't arrive for another month, and you're technically not paying for those clothes until you pay the credit card bill. In the meantime, the credit card issuer will have paid the clothing store from which you purchased your clothes. If you don't pay your credit card bill in full when you pay, your interest rates will go up. Simple and compound interest. Interest is the price paid for the use of borrowed money. Principal is the amount of money borrowed, and simple interest is interest paid only on principal. For example, if you deposit $100 in a savings account at a rate of 5% interest, you'll make $5 in 1 year, assuming the interest is paid annually. Compound interest is interest paid on both principal and accumulated interest. Basically, this means that as long as you leave the $105 in your savings account, you'll earn interest on that extra $5 that you earn. This is a table that I made for compound interest. $100 deposit at 5% interest compounded yearly. So principal at the end of 15 years would be $218.29. Banks and profit. The largest source of income for banks is the interest they receive from customers who have taken loans. The amount of interest they pay out is less than the amount of interest they charge on loans. This is how they make a profit. Types of financial institutions: commercial banks, savings and loan associations, mutual savings banks, and credit unions. Commercial banks traditionally serve businesses. They offer checking accounts, accept deposits, make loans to businesses and individuals. Some commercial banks are chartered by states and are regulated state authorities and by the FDIC. About a third of all commercial banks are national banks and are part of the Federal Reserve System. Commercial banks provide the most services and play the largest role in the economy. Savings and loan associations. They're originally chartered to lend money for building homes during the mid-1800s. They're also called thrifts because they enabled thrifty working class people to save up and build their own homes. Over time, savings and loan associations have taken on many of the same functions as commercial banks. Savings banks, also called, or they were originally called MSBs. They originated in the early 1800s to serve people who made smaller deposits and transactions than commercial banks wished to handle. They were owned by the depositors themselves, who shared in any profits. Later, mutual savings banks began to sell stock to raise additional capital. These institutions became simply savings banks because depositors no longer owned them. The Consumer Saving Bank of Worcester, Massachusetts, introduced a negotiable order of withdrawal account, a type of checking account that pays interest. Now accounts became available nationwide in 1980. Credit unions. Credit unions are cooperative lending associations usually established by and for particular groups, usually employees of a specific firm or government agency. Some are open to an entire community. They are usually fairly small and specialize in consumer loans at interest rates favorable to members. Some also provide checking account services. Finance companies. Finance companies make installment loans to consumers. These loans spread the cost of major purchases, including cars and large appliances. Because people who use finance loans usually don't repay their debts, their interest rates are higher. Electronic banking. Banks began using computers in the early 1970s to keep track of transactions. Computers' roles in banking have increased dramatically. In the book it says, in fact, computerized banking may revolutionize banking in the same way that paper currency changed banking. Automated teller machines. One of the most common types of electronic banking. ATMs are computers that customers can use to deposit money, withdraw cash, and obtain account information. They're usually available 24 hours a day. Debit cards. A debit card is a card used to withdraw money from a bank account. You can use them at ATMs and at the store. When you swipe, the card sends a message to your bank to subtract money from your checking account. That money goes directly to the store's bank account. For security, debit cards have PIN numbers. Home banking. Many banks, credit unions, and other financial institutions allow people to check account balances, transfer money to different accounts, automatically deposit their checks, and pay their bills via computer. Automated clearinghouses. They're located at Federal Reserve banks and other branches. They allow customers to pay bills without writing checks. And automated clearing houses transfer a fund automatically from customers' accounts to creditors' accounts. A creditor is a person or institution to whom money is owed. They're used to pay mortgage payments, rent, utility bills, and insurance premiums. Stored value cards. They're also called smart cards. They're similar to debit cards. College students may be issued a smart card to pay for cafeteria food, computer time, or photocopying. Phone cards and gift cards are also a form of stored value card. And this is the vocabulary from the chapter.